In November 2021, the screen glows with a number that changes everything. Sarah is an early director of product at a hyper-growth software firm. She sits in her home office, staring at her employee brokerage account. The balance reads $3.4 million. It is a mix of unvested and vested company stock. For Sarah, this number represents years of late nights, missed weekends, and relentless corporate sprints. She feels a profound sense of arrival. She believes she is financially free. That is the vesting illusion. Paper wealth creates a false sense of autonomy. You look at your own equity portal and feel a sense of security. You see the green digits and assume they belong to you. But until those shares are liquidated and diversified, they are not truly yours. They are a theoretical number. They are held hostage by your employer. You are looking at a mirage, waiting to vanish. 6 months later, the first major vesting cliff arrives. The shares officially hit her account. The brokerage automatically sells a portion to cover the income tax through a standard share surrender. Sarah looks at the remaining stock. She believes in the upcoming product launch. She trusts her CEO. She chooses to do nothing. That is the default action trap. Doing nothing feels passive. It feels safe. It is actually an aggressive, active investment decision. The math of corporate equity is entirely unforgiving. Holding vested equity is mathematically identical to taking your cash paycheck, walking into the open market, and using 100% of it to buy your employer's stock. You would never do that. It defies every principle of risk management, yet by holding the vested stock, you do exactly that. You mistake corporate loyalty for smart investing. You let inertia dictate your financial future, one vesting cycle at a time. By early 2023, the macroeconomic winds shift. Interest rates rise. Capital becomes expensive. The era of hypergrowth ends. The company's valuation compresses by 40%. Sarah watches her net worth plummet. Panic sets in, but she refuses to sell. She is waiting for the stock to bounce back. She is trapped by the endowment anchor. The human brain is flawed. We value assets we already own far more than cash. We anchor to the all-time high. Sarah remembers the $3.4 million. She feels she is owed that peak number. The math points clearly towards selling to preserve what is left. The psychology forces total paralysis. You watch the red numbers in your own portfolio and tell yourself it is just a paper loss. You tell yourself you only lose if you sell. You are lying to yourself to avoid the pain of accepting reality. The breaking point arrives quietly on a Tuesday afternoon. The stock drops another 45%, following a disastrous earnings call. The company's market cap has cratered. The board of directors mandates a 15% workforce reduction. Sarah is called into a brief, impersonal video meeting. Her employee badge is deactivated on the exact same afternoon. Her income drops to zero instantly. On that very day, her portfolio hits its absolute lowest point. The balance is now $500,000. 85% of her wealth has evaporated. This is the correlated collapse. This is the catastrophic danger of linking your human capital to your financial capital. Your human capital is your ability to earn wages. Your financial capital is your stored wealth. When both are tied to the exact same ticker symbol, you do not have wealth. You have leveraged employment, balanced on a knife edge. In the silence of the aftermath, the autopsy begins. Sarah sits with her financial statements, realizing the gravity of the concentration risk she took. She accepted all the idiosyncratic risk of a single company. She took the financial risk of a founder. She had none of the operational control. Concentration can build wealth. Diversification is the only way to preserve it. You cannot predict the future of a single company. You cannot control macroeconomic shifts, executive missteps, or algorithmic trading sell-offs. You can only control your exposure. True wealth building requires a harsh realization. You must aggressively sever your financial capital from your employer. Loyalty to a company is an admirable professional trait. Financial loyalty to a single stock is reckless and entirely uncompensated. 2 years later, a new dashboard tells a different story. Sarah has moved to a new role at a different firm. She no longer relies on hope. She relies on a blind liquidation system. She has established a strict, automated 10b5-1 trading plan. The exact moment new shares vest, they are liquidated. The cash is immediately routed into uncorrelated broad market index funds. She never sees the company stock in her account. She never feels the temptation to hold. The emotion is entirely removed from the equation. Your employer provides your income. The global market must protect your capital. Wealth defense requires ruthless, automated separation. You must build an impenetrable wall between your paycheck and your portfolio. That is the law of capital separation. That is how you survive the illusion and build lasting financial freedom.